trade, especially when you correlate that with the Asian session, which is what this is right here. This is from, basically starts from 2 p.m. Eastern and doesn't end until basically the London Open when we initiate out of that range. So this is that Asian session. And a lot of these ranges do occur around the Asian session just because there's a lot lower volatility and volume that's being traded within the markets. But again, it's all about understanding liquidity, understanding the cause that's being created as prices, for instance, moving to the upside. What is this telling us? As we're pushing higher, we're starting to create significant swing lows. And regardless of how you're trading, some people like to trade some type of flag patterns, things like that, where they're going to put their stops. They're going to put them just under there, even break-even points. You can even see that we have multiple small range liquidity that's within all of this. And what we can see is we have range liquidity here as well. We initiate out and then we initiate up. If I can draw that a little bit cleaner. We've taken the buy side liquidity, but we have sell side liquidity. So if we just drag that over, we can see that we break to the downside. And basically what this is allowing us to see is that price has a willingness to trade lower at some point in time. We can also start to see that we have some mitigation liquidity as well. We mitigate here. And then we're starting to see effectively mitigation liquidity starting from a momentum shift as well. We're starting to see price starting to do this sort of behavior, which gives us the indication that when price breaks to the upside, a logical target to be targeting would be up here. We also need to keep in mind that we have equal highs that are forming. So we have liquidity, So this is a pretty key area. As we can see, if we just drag this all over, we're in a much larger range. So if we went up to say a 4-hour chart, for instance, we can see that we're in a much larger range. Where's the liquidity? Where's the liquidity? Now it's all about where is price likely to break out. And that's the thing. We don't know where price is going to break out. If we go on conventional impulse, sideways correction, and then continuation, then a range to this degree would make sense, which would mean at some point we were going to draw on the liquidity. We also have liquidity up here. So everything makes sense. But at the end of the day, price could also do this impulse correction, and then impulse back to the upside, and then we end up having more liquidity, and then we look to the left, oh, we have more liquidity here, we have equal lows here, equal lows. Again, we're on the 4-hour chart, but this is where you start to piece together all the puzzles, and we can see, you know, if I'm just drawing out liquidity at this point, we have equal highs here. What happens? We sweep those equal highs. But what did we do before? We created equal lows, we swept those, and what we also did was we tapped into a 4-hour demand zone. Just draw it from these candles right here. We tap in and go. So it's basically taking all the sell side liquidity, all the buy side liquidity, running up. And what does that show us as we're seeing this run up in price? We have some pretty significant swing lows that are being created. If we just draw it on these two most recent, and then we just match price here, not only do we have a 4-hour demand zone, we also have this intent, this cause for lower prices. We can see that we have it right here as well. So if price does continue to move to the downside, we're starting to see targets that make sense from a trend line mitigation liquidity as well as a momentum shift liquidity. So again, we'll just go back here, and this is exactly what we're looking for and what we're looking at. So I highly recommend just looking at a chart, grab your pen tool, grab your highlighter, grab a trend line, whatever makes sense for you, and just start marking out the structures. Just start marking it out. It can be on the 1-minute chart, it can be the 1 hour, the 4 hour, the daily. It's all going to work. It's all going to show you the same thing, because at the end of the day, price is fractal, and what you're going to see happening on the lower time frame, you're going to start to see happening on the higher time frames as well. You know, if I go here on the 1-minute chart, what we can see is as price is moving down, we're creating all of these swing highs. This is creating trend line liquidity. If we just move to the left, what happens? We end up breaking that liquidity. And what we can see is we do have a set of equal highs here as well. So it just adds to the fact that price wants to move to the upside. We have equal highs here. We create more liquidity to the downside. We have equal lows, relatively equal lows here. We also have more specifically trend line liquidity here, trend line liquidity right here. And if we just look at how perfectly that taps in here, then we're starting to see mitigation liquidity. And if we move to the move over, we can see we break that to the downside. We start to look and move back here. We can see if I just draw on stuff like this, we have liquidity right here, liquidity right here. I'm just picking random spots, but as we can see, all these pieces start to pull together, and this is why ultimately price is doing what it's doing. If we just move this back to right here, what is this? On an even lower time frame, but we can even see it here on the 1 minute. This is a range bound liquidity, range bound liquidity. What do? We sweep that liquidity there. We also have a potential demand zone that price taps into as well. And then if we just kind of keep moving over, I know this is getting incredibly messy, but I just want to just keep breaking down price action because liquidity is just so important. And once your mind really switches on to these concepts and understands what's really happening behind the scenes, your trading is just going to take the next step. Equal highs. We have range bound liquidity. We sweep to the downside. We sweep to the upside. We have relatively equal lows. Mitigation liquidity. This is a much more smaller. This is basically, actually, if this is kind of a neat example. If we look at this bit of price action, we have range bound liquidity, we have mitigation liquidity, and we also have momentum shift swing low liquidity, and we also have equal low liquidity. What ends up happening if we just move to the right, price creates the same thing. So if we just draw that in, we create, again, range bound liquidity, equal low, equal highs. We just sweep those areas. Then we moved back to the upside. What we can see is more than likely on a lower time frame, this is probably a clearer supply zone, but more than likely that would be effective to look for that. But as we can see, if we had taken sells from here, something like that, stop loss, let's just do it above the wick just for the bants. But if we were looking for potential targets, one of the first things that we'd want to look at is we have a swing low here, so we know that the liquidity is more than likely going to be run. We have range bound liquidity that has yet to be tapped into. We have those mitigations we've seen, so more than likely price is going to react off of this in some way, shape, or form. And what we can see is as price comes to the downside, we start consolidating. So this would be a great spot to look for partials, because if we look on a higher time frame, this is a potential order block. And what we can see is price comes to the upside, but we fail to break any significant highs. And then price continues to the downside. We then break the equal lows. We continue moving to the downside. What do we end up doing? We start creating trend line, momentum shift, swing high liquidity. We sweep that liquidity. We also create a supply zone. Price taps into that supply zone, continues to the downside. We do have smaller lows here that would probably be visible on a much lower time frame, but that's not overly something that we'll get into since we're already here on the minute chart. I'm only on the minute chart just to show a lot more data and just show how these concepts really do work. We can see that we're starting to get a swing high, a swing high. We get basically, before this candle happened, we had equal lows. We swept the lows. We also had equal highs. So we have range bound liquidity here as well. Price then moves away. What do? We create another range. We come back to the upside, equal lows. We also have sloping swing high trend line liquidity. We continue to the upside. What do we see here? We've tapped into a demand zone. We've created this key swing low within all of this price action. Why? Because at the end of the day, price action, when it creates a major low or high, there's also liquidity resting under those highs. So yes, we do talk about double tops, double bottoms. It's also important to also factor in just really key swing highs that happen almost out of nowhere, because as we see, or not, maybe not out of nowhere, but something that's very prominent. As we can see, this one right here, if we just look to the right, what ends up happening? We sweep the liquidity above that high. Why is that? Because anyone who sold here, even on this supply zone or this double top, whatever you want to call it at this point, because it is a supply zone, but it's also kind of equal highs at this point. So we have liquidity resting above here. What ends up happening? We sweep the liquidity, but what did we also do? We created equal highs, and then we look to the right. We've created another swing high. We're starting to build trend line liquidity to come down. We have a demand zone right here. So does price come and then continue to the upside, sweeping liquidity? Very possible. But we also see that we also have trend line liquidity here as well on a series of mitigations. So we could sweep to the downside as well. And this is where liquidity can get confusing, because we don't know where price is going to be going initially, or where it's going to go first before it returns to anything. And what you end up getting is a garbled mess of price action. But this is, again, where you can start to use the fractal nature of the markets and use higher timeframes and lower timeframes in unison to understand where the liquidity is being created and where it's bound to tap into. Because now that we're looking at this on a 5-minute, things start to get a little bit clearer. We have equal highs forming, so we have even more liquidity being formed on a higher time frame. We have equal lows here as well. So we're now creating range bound liquidity. We have a supply zone right here on the 5-minute, so price could sweep the liquidity and then come to the downside, sweeping all of this liquidity as well. We don't know what's going to happen, but again, it's just about filling in price action, understanding the liquidity that we're creating, and just using that to our advantage. You know, we can even see it on the daily chart. We created these swing highs, the sloping trend line. It's also a larger range. What do we end up doing once we get there? We spike into it. Then there's no coincidence that price taps into that. Of course, we react. We also have trendline liquidity here. We tap into it. And then what we can see here on pound dollar right now is that we are creating a lot of liquidity here, a lot of liquidity here as well. Got some liquidity right there. So this could be used for future prices to come to the downside, because we do have a demand zone that's resting down here as well. Getting a little ahead of myself. I don't want to go too much into all of that good stuff, but it's basically about just understanding what's happening here on the charts. You know, we have trendline liquidity. What ends up happening? We're approaching this area. Why are we approaching that? Because there's liquidity that rests above these highs. We had equal highs. We've run on the equal highs. We had equal lows. We've run on the equal lows. Equal highs here, collection of equal highs. It just keeps happening. Why? Because liquidity. And that's why some of these trading strategies that we see that trade flags and things like that, that's why they do work. Because at the end of the day, it's just a form of liquidity. You know, I'm starting to draw patterns and good stuff like that. But again, I'm just looking at liquidity. What do we have? Trendline liquidity to the upside. We have equal highs. We sweep those equal highs. We've created mitigation liquidity. We swept that liquidity. What have we dropped as we've come down? We've dropped swing high liquidity. So we can look at that point as a future reference point. We can go to even to this point, we have trendline liquidity. Where do we come? We have equal lows here. Why did price sweep that? Equal lows, trendline liquidity. We have swing high here. We break that. And this is the concept I'm just trying to point. We've looked at the 1 minute chart. We've looked at a 5 minute chart. We've looked at an hourly chart. We've looked at a 4-hour chart. We've looked at a monthly chart, a weekly chart. Liquidity is fractal. The markets are fractal. All these concepts are fractal. And if we can start to piece together all of these components, this will give us the edge to understanding where price is likely bound to go. Again, this isn't an end all be all, because you don't know if price is going to target, say, this liquidity first, or are we going to hunt this liquidity before? Because do we need all of this fuel to then break this area liquidity to then tap into this liquidity? We don't know. But at the end of the day, what we then can do is build our trade ideas with the understanding that we know where the pools of liquidity are, whether it's on the higher time frame, whether it's on the lower time frame. The higher time frame will help us build an overall bias and sentiment based on price action, and then the lower time frames will allow us to put all of those puzzle pieces together to vet our supply and demand zones, to vet our areas of imbalance, to vet our trade ideas that we're starting to develop. Then when we take them to our entry time frames and we're starting to look for confirmation entries, when we're starting to look for double confirmation entries, when we're starting to look for scale-ins, we can start to pool in where is the liquidity, where is price likely to go. If price is going to pull back, where is it likely going to pull back to? Is it going to pull back and take out equal lows? Is it going to take out equal highs, then target equal lows? Again, we don't know what it's going to do, but once we can plot and understand liquidity, these questions become a lot clearer. So what I highly recommend after watching this video is just opening up a chart. Doesn't matter which pair it is. It really does not matter. Plot out all the areas of liquidity. Make your chart look as messy as you need it to be, because I guarantee that by the end of it, you're going to have a light bulb moment of just totally understanding how the markets are starting to move and then being able to implement that into your trading strategy. Again, it's not going to happen overnight. It's probably going to take a few run-throughs on charts to just start dissecting this. But the next step that you can also do once you've gone through this exercise is start looking at your previous trades and start identifying your higher time frame analysis when you were targeting specific areas. Was it in line with liquidity? Whether it was a winning trade or a losing trade, it can give you a little bit more of an edge or an understanding on why a trade worked or why it didn't work. Maybe you took a 1 minute confirmation entry on a 4-hour demand zone and price looked good based on price action. You see that committed break of structure, you see an imbalance, all the things that we look for, but price still broke to the downside. But then you look into how the confirmation entry came to be, and you start to notice that we started to create more trend line liquidity as we started to come up, which gave us more equal lows or relatively equal lows. Price came down, and then that's when we got that true break of structure, and then we started to get that true trend line liquidity to then break to the upside. Because what we can see is now we're starting to build a case for price to go to the upside, where this is starting to first bring price to the downside. So that's something I highly recommend, is just draw it out on the charts, and then also review your trades, winning and losing, and just factor in the liquidity components that maybe you overlooked or didn't necessarily know. Because at the end of the day, we're forever improving our knowledge on trading. And I truly believe that liquidity and applying these concepts to your trading and this understanding of liquidity is going to take your trading to a whole nother level. It's just going to allow so much more clarity when you're starting to look at things, when you're starting to understand why price did what it did, why it's doing what it's doing, and what that's signifying to you. So I hope this video was helpful. It's a little bit later than what I had initially wanted to do, but I wanted to take some time to really sit down and put together as much information as I can. And again, just walk through price action, walk through this example, whether it was on a weekly, a monthly, a daily, a 4-hour, a 1-hour, a 5-minute, or a 1-minute time frame. We could even go down to 30 seconds and see the same things repeating over and over again. Trendline liquidity, equal lows. We also have sloping trendline from mitigations. We come to the downside. We sweep that. When we can see that we have sloping liquidity. We don't quite get all of it, but what do we see? We also have a demand zone here we've tapped into, and then we run off. Just exemplifies that. We can even go to 5 seconds and start looking at this garbled mess of the matrix that price action is. My computer doesn't even want to load the charts. There we go. And we can, again, start to look at even more fractal price action that's happening in the markets. We're starting to build that liquidity, building that liquidity, equal lows. This is range bound liquidity. I'm not going to go into 5 second because this is just ridiculous to look at. Like, just look at some of these candles. It's confusing. But anyway, I hope this video was helpful. I hope there are a couple light bulb moments that come as a direct relation to this video being dropped. I'm going to continue expanding my knowledge and my interpretation of liquidity as time goes on, as we start digging into commentaries more, as we start creating new content, things like that. But I feel like that this is the foundation of what we're trading in a nutshell. We're then using supply and demand to understand where we're going and where we're likely to react off of from zone to zone. And then we're using that liquidity, we're building that liquidity to then take us to where we need to go. Because looking at this example, for instance, we create these swing lows, we've tapped into this mitigation, we create this range, move to the downside, we sweep some of the liquidity here, tap deeper in here, then we come down, we've tapped into this demand zone, so we've created equal highs, we've come down, we've created more liquidity up here. This liquidity then fuels us. Look at how big this candle is. Clears all of the liquidity here. We start to create range bound liquidity. We sweep that liquidity, and now we've come back down to fill in this imbalance. And it's all of the components of our strategy into one really nice example that I just thought of as we're going through this now. But again, I'm going to wrap this up. I feel like I'm rambling now. Hope this was helpful.